Morning, Wall Street winners. It is Friday, June 28th, and we have some data from the Consumer Price Expenditures, or CPE, data coming in, and it was in line with estimates. So really just another data point for the US Federal Reserve to look at what's going on in inflation, and it does appear that it's slowly coming down, but I think we're still a ways out from a rate cut. So that's where we are. One more data point to talk about. We'll hear more on that later today from a few of the Federal Reserve chairmen or members of the committee in particular. We also had Nike earnings out yesterday, and I think this speaks more to inflation and where consumers are than anything else, because I think Nike is, in my mind at least, a brand that the general public, and maybe not higher end consumers, but the majority of consumers, both low and middle income, tend to purchase, had poor earnings and revenue results and future forecast. And they're off about 14 or 15% in the pre-market this morning after that announcement after hours yesterday. And I think it just speaks to the fact that consumers these days, and probably for the remainder of the year, feel extremely stretched. They just do not have the same level of consumer income that they did previously. So that is a challenge for the economy, because it's going to impact the earnings of a lot of different companies. And I think this is a really important point to hone in on. And I think the point here is to really take a strong, hard look at discount retailers, because discount retailers are going to fill this short-term gap where consumers are stretched and they don't have the same level of consumer disposable income that they did previously. And then on the flip side, stay away from high-end retailers. So I'm staying away from not luxury retailers. So let's differentiate, because high income individuals still have a ton of disposable income and have done very well through the last 4 years, and even with interest rates increasing, because they don't have the same level of debt that low income households have. So the debt coverage ratio for low-income households could have, in the worst case, gone up by a magnitude of 5 times. So that's a significant increase, because no one's wages have increased by 5 times. But interest rates going from close to 0 or 0 to 5 or 6% is a 5 times increase for these people. So having to take what was disposable income and now put it toward basic needs like rent, and at the same time seeing food costs go up to a magnitude of maybe not 5 times, but probably I don't know what they've gone up. I'm going to say 2 times, maybe 1.5 times, maybe 3 times. Whatever it is, it's a significant increase in the cost of food. And those are basic needs that everyone has. So people are feeling stretched. And so luxury retailers like your LVMH that sell $10,000, $2,000, $50,000 handbags, not a problem for people with money. But the likes of Lululemon and some of the other mid-tier retailers, I think we're going to see them start to struggle, and which we already have in the case of Lululemon and some others. And they would be companies that I would be staying away from at this point, but I would be looking at discount retailers, your Dollar Tree, your Walmart, but be very specific, because others got hit hard, right? Like Target. Walgreens is getting hit hard. So again, I would call Walgreens and CVS more of a premium retailer because of the prices. They're more of a convenience store retailer that can justify higher prices in a smaller square footage location, because they are focused on a specific need, and they try to expand around that and upsell on other products. So what we do have going into the market today is all of the averages right now, 15, 20 minutes prior to open, are in the green. I think we're going to see some positive lift before in this trading day, because we're kind of heading into we're definitely heading into a short week, but we're heading into a slow trading week. So next week we will get a little bit of data coming out, I think next Friday is when we get the jobs report. So that'll be probably the most critical piece of data. But it is Canada Day on Monday. It is the July 4th weekend or holiday, the Independence Day on July 4th on the Thursday. So it's going to be a fairly subdued week. A lot of traders will be out of the office. Obviously, retail investors can trade from anywhere, but they do not make up the majority of trades in the market. It's all really institutional for the most part. So we're going into a quiet week. So what do we look for in today's activity? Well, first of all, the nice thing to see is that crude was up. It was up significantly. It's still up 35 cents and it's above $82. So I'm going to skip through health and retail because I have touched upon it. I would look for any kind of dips like yesterday in Walmart. I think Walmart could be an attractive purchase if it gets down to the low 60s, which I do believe it could get down there. I would stay away from Home Depot right now because I think it's not a need-based type of purchase. It's more a want-based type of purchase in many cases. And if you are buying it for a need, you're not spending significant amount of money. You're going in to just buy one individual or a few individual items to fix something in your residence and then be done with that or have someone fix it. Nike, you can see off $15 pre-market, so it got hit hard. And then you've got the healthcare, and healthcare's just kind of been trending upwards, but hovering in a bit of a range. We had a good day yesterday for Humana. It's up $7.89 pre-market, which if you've been listening to my videos means absolutely nothing. It could actually open down. So you want to be a little bit skeptical on moves like that pre-market. JB Hunt is very attractive. So even though the consumer segment and discretionary is down, JB Hunt has been hit hard. It is trading in this range of 56 to 62, and at the low 57s, if it opens and dips down to the 55 or 56, I would definitely look at adding some of this in the short term to a portfolio because I do believe it'll bounce again. CNR is another really attractive one, especially if you're looking at the long term. Down at 161, I do believe it's going to come down more, but we'll have to wait and see on that one. I wouldn't be buying it right now, but I would wait for a dip into the 150s. It could even get down to the low 140s or mid 140s. I am watching in the oil sector. I think oil's going to have a good day today based on crude. It looks positive across the board in the pre-market. A lot of green on the screen for our refinery stocks, and if we see a bit of an uptick again and get up above or to the mid 82s for crude futures on August 24th, I think we're going to have a really strong day. I do believe that we're going to have a good year in oil overall. It may not be like a few years ago where it was record highs, but these companies are generating good revenues, good profits, which is unique in today's economic environment, and they're generating free cash flow. And that is critical to paying dividends, which most of them do. The other one to keep an eye on is the utility, Con Ed. So Con Ed is down in below 90. It was up at 96 within the last month. I think this is going to come back down into the 86, 87 range, and then it should pop again. It may not pop on a day basis, but within 5 to 10 days of hitting a low of, say, 85, 86, or within 30 days, within a month for sure, it will go back up into the low to mid 90s. Cruising down into tech. Tech has some sweet spots in it for sure. What we're seeing is a bit of a pullback on some of the Fab 5, Fab 7, whatever we're calling the large capitalization group of companies like NVIDIA, Microsoft, Amazon, etc. But we're seeing money put into some others. And so we've seen a pop recently in CrowdStrike for cybersecurity. Palo Alto has been doing well. PanW, you can see that it was up $15 yesterday. It's back up at 340. This was a stock just a month ago trading down in the 270s. You've got Net coming back, which is Cloudflare, which is another cybersecurity firm. It's breached the $80 mark. It looks like it could get past 82 today. This was a $110 stock 3 or 4 months ago, and it looks like if earnings are on track, it could get back to that point. Microsoft at 452 is at its all-time high, which is not a place where you really want to be as money flows start to shift. So I would look to diversify some of my Microsoft if I had it. And I'm not suggesting in any way that Microsoft is a bad company. It's an absolutely fabulous cash generating company, but it's a big cruise ship and it doesn't pivot or move quickly. They've also recently unveiled or announced some security leaks that they initially said were to their executive group, and now that seems to have been a broader leak and hack. So they're making some pretty significant investments around security internally to try to avoid that going forward. You can see AMD down in the 150s, not unattractive, but I think you've got a lot of other options that could do better by the end of the year. One of those, Workday. Workday had bottomed out in the low 200s, and it is now up at the 223, the 220 level. So I think that's going to continue its recovery kind of trajectory. Another one that I skipped over that's making a comeback up at the top here is Salesforce. So Salesforce dropped significantly. It's now climbed almost $10 yesterday up to the 252s. This stock's going to get back up into the 330s without a question by the end of the year, because they're going to start to turn the ship around there. And then as we scroll down and take a look at some of the others, the big one are the semis. So if we look at Broadcom, again, one of those ones that has really done well, hockey stick type growth. I'd be staying away from Broadcom right now. Tesla's making an interesting comeback, but I'm not sure we have material news to really substantiate and justify that. Amazon is on a bit of a tear, but it is as well at a bit of an all-time high for the last few years. So I'd be a little leery there. If you're looking at something long-term and you believe that China is making a comeback, which I believe is happening without really making the news media, I think Alibaba, or BABA for the stock name or the ticker, would be a great investment. I'm a little reluctant around NVIDIA because it is near that all-time high, but I'm also interested to see what happens. I think at the low 120s, it's still very attractive. Google, I think, is going to come off, and it looks like pre-market it is doing that, come off its high of 186. I'd wait till Google gets back in the 170s myself. Adobe has dropped significantly this year, and it's making a comeback. So it's the stocks that are kind of out of favor, but making a comeback, possibly got hit hard by a bad or okay earnings report. You look at Micron. Micron this week had a great earnings report and revenue report, and they actually hit on future forecasts, but they still took a hit. So I'd be looking at picking up some of those that have taken a short-term hit and just play that recovery on those and watch those go forward. The other sector we're seeing make some moves now, and this will be really the first sector to report going into July earnings season, which is only a few weeks away, is the financials. And I'm a huge believer in SoFi. This has climbed from the low 620, 630 range up to 654. Looks like we're going to get at least into the 660s, if not the 670s or 80s today. It's making a nice little comeback, and a 7-cent increase in this stock is a significant pop in terms of percentage growth. So if you can get a 20 to 40% increase on a $6.50 stock, you're doing really well percentage-wise. The other ones that are obviously making moves in the market, JP Morgan, but a little expensive in the high 190s. Morgan Stanley, not unattractive at the 95 rate. And I bought into some Goldman yesterday at 446, and it looks like it's going to take a nice little pop this morning. And I think we're going to see some positive activity coming into today's close on the financial stocks. Now, these are going to be dependent on the move of the Dow, but most of the negative energy is in the retail segment of the Dow. Oil and financials seem to be doing well, and I know those aren't the only sectors, but they could cause the entire index to go positive. So that's where we are on the trading day today. Good luck with your trades, manage your risk, and stick to the fundamentals. Get out of your trades when you've made a percentage gain, take the gain, sit in cash, and wait for another buying opportunity. And based on my success, you can achieve similar results in your portfolio.